Just to go very quickly over the data here, in the green, you have if somebody invested in the S&P 500. So this is someone who invested in one exchange-traded fund that just mirrors the stock market, and then they went to the beach for the next 30 years. That's what you have to do to be successful with this S&P 500. You have to do nothing. Unless you're a trading genius, it's a very thin margin of error. If you miss just the top 10 days, right, your performance is way lower than if you just did nothing, right? So why do people trade so much? One reason is a simple misunderstanding about what a stock is altogether, right? So this is where an example where vocabulary is very important. So what is an equity? Equity means ownership. What is stock? Stock is shares of a stock in a company that you own. I'm an owner in Apple. I'm an owner in Google. If you thought of yourself as owning shares in a local dry cleaner, if you own 1/3 of a dry cleaner with your brother and your sister, you wouldn't think that you have to be constantly trading it because you're an owner, right? Apple's no different. You just own 0.003%. A lot of us associate work with virtue. Work is good. People who work are good. But as we've demonstrated through the data, in a very perverse sort of way, the more you work on your stock market investments, the worse it gets. Another reason why people trade a lot, and this is especially important with the young people in your life, the brokers want you to trade. Now that we have on our phone brokerages that we don't pay commissions for, the way that they make money is by making very tiny amounts of money on high volumes of trades, right? So they are quietly manipulating these software programs to get young people hooked on trading, right? When in reality, trading is often the last thing you want to do. People trade a lot because they're bored. So they just start playing with the casino in their pocket. Terrible. Go get a hobby. And then, of course, the obvious thing, fear of loss, right? So I try to engage very deeply with clients about how they conceptualize risk. And then I try to role play with what has been their past experience with financial crashes or financial setbacks, and to try to understand how each person goes emotionally, how they handle financial pressure and how they handle ups and downs. And when you can help a person understand themselves better, that cuts down your odds of the notorious freak out. When I work with someone, or if they're going to work with a therapist, or they're going to work just with themselves online, I try to get them to ask hard questions of themselves so that we can preempt the freak out.